Uber stock is up 28% in the past year. It has underperformed the S&P 500 significantly in the past 3 years, so let's see if this is a good opportunity to buy the company by looking at the fundamentals and running a discounted cash flow model to calculate the intrinsic value of the company and potential future returns. Uber has seen insane revenue growth in the past decade, growing from $3.8 billion to $49 billion currently. And analysts are still expecting a lot of revenue growth as they have Uber reaching $53 billion this year and grow to $78 billion by 2028, which is around 15% annual revenue growth. They've also seen very good growth in profit, as Uber was an unprofitable company 3 years ago, and they are now generating $16 billion in net income. However, a negative aspect about Uber's financials is that they have significantly less free cash flow, as they are generating $8 billion, so they have half the free cash flow. They have good margins with gross margin being at around 34%, profit margin at 33%, and free cash flow margin at 17%. And one thing that I used to be concerned about in the past was the share dilution, as they were issuing tons of shares, which was horrible for investors, as they own less of the company and share the profits with less people. But it seems they've stopped doing this in the past year. Analysts are expecting little profit growth in the next few years, as they have Uber reaching $5.35 per share this year and grow to $6.04 per share in 2028. Although I don't know why they have Uber decreasing profit by 32% in 2026. By the way, if you assign a 20p to those 2028 earnings, it would make it a $120 stock, meaning 51% returns from current levels. Uber also has a great balance sheet, as they have $9 billion in cash and $13 billion in debt, which is nothing for a company that has a market cap of $164 billion. And then, in order to calculate the intrinsic value of the company and potential future returns, I use my Google Sheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $70 per share, middle $122, and high $201. And because the stock is currently trading around $79 per share, this means that if my low assumptions occur, you would get a 7.8% annual return on your money, middle 18%, and high 22%, which are great returns because keep in mind the market gives you around 9 or 10%, so you would beat the market according to my middle and high assumptions. For as my assumptions, I assume Uber grows revenue annually between 8 and 16%. Over the next 7 years, they average a profit margin and free cash flow margin between 14 and 22%, and I assigned the PM price to free cash flow at the end of the 7 years of 17, 19, and 21. But if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. Now, Uber is also trading at a PE of 23 and price to free cash flow of 19, and therefore we can conclude that in terms of valuation, Uber is trading at a discount. So far, the fundamentals and valuation looks good, but now let's take a look at the risks before giving a final conclusion. One of the main concerns is that robotaxis are a threat to Uber. However, I actually don't believe this. Uber teamed up with NVIDIA to develop driverless car technology, and Uber will be scaling its global autonomous fleet starting in 2027, targeting 100,000 vehicles and supported by a joint AI data factory built on the NVIDIA Cosmos platform. Driverless technology could be a major upside, since one of Uber's larger costs is drivers. And for example, if laws or courts force Uber to treat drivers more like employees instead of contractors, Uber's costs could jump. Benefits, payroll taxes, scheduling rules. And therefore, I believe autonomous driving will help Uber. The other main risk is competition. In the US, Lyft directly competes with Uber in the ride segment and DoorDash in the food delivery segment. This could squeeze margins. And a big advantage about Uber is that it is known in the whole world. Looking at the revenue by geography, we can see that they are growing in the US, Canada, Europe, Middle East, Africa, Asia Pacific, and Latin America. And in conclusion, I believe Uber is a great company with still a lot of upside potential and trading at a small discount, which is why investors like Bill Ackman have decided to buy, which by the way, it's his largest position. It's getting very close to my buy point, which I would say is around $60 per share. The reason I am not buying yet is because I believe there are better opportunities in the market, for example PayPal. And with Uber, I believe there is still some uncertainty, which is why I need a big discount if I decide to invest in it. Lastly, if you want a discount on stockanalysis.com, grab my code in the description. I hope you found this video valuable. Let me know what you think about Uber stock in the comments, and I'll see you in the next one.